Interest rates are rising. What do you need to know about that? Well, here to talk with me about that very topic is Matt Stratman from Western International Securities. Matt, welcome.
Thank you. Thank you for having me.
It's a pleasure to have you here. So the Fed is set to increase interest rates and investors are worried about rates rising. And what do we need to know about that?
Yeah. So first of all, interest rates are rising, and this is something that will have an impact on the prices of stocks and bonds and our economy. But it's not something that every investor out there needs to lose sleep over. A well-prepared investor should be able to weather the rising interest rates without it being overly devastating for their portfolio.
Yeah. So just a bit of a primer. Why do rates rise and fall? What causes that?
Well, the main principle for just about any rise or fall in prices is supply and demand. So when supply is greater than demand, rates are going to go down. The supply of available loans, the supply of interest rates, when banks are more willing to lend, that's going to actually drive interest rates down. Now, when there are more people more investors, more individuals, more corporations that are looking to borrow, and banks are restricting their lending, that's going to drive interest rates up. Part of what's restricting lending, or a big force to what is going to be restricting lending, is the Federal Reserve. They have the power to raise or lower the federal overnight interest rate. They also have the power to purchase or sell bonds on the market themselves, or not sell, but they purchase bonds, and then the bonds that they're holding, then they can actually sell those and put those onto the market. And so that's going to affect the supply and demand of interest rates in the economy, and it's going to have an impact in the coming months and years in our economy.
So what's at risk when rates go up?
So if rates go up, that's going to, the intended purpose for the Federal Reserve of raising interest rates is to slow down our economy. We're seeing inflation right now in the economy, and when inflation is getting to the point where it's at now, the 7% year over year, plus or minus, a little bit here or there, that's a little bit high, and the Federal Reserve is trying to slow down the economy. So what's at risk is the sectors in the market that have benefited from rates going down, essentially. So that would be real estate. Real estate has done tremendously well over the past couple of years because rates have been going down, and buyers are out there buying real estate while rates are low. As rates start rising, you may see a slowing to the real estate market. You may even see a plateau to prices. If Federal Reserve slows down the economy too much, we may even see prices go down because it's less affordable to purchase things with, the real estate with a loan as rates are higher than when they're the 3 or 4% rates. In addition to that, and I may even say the biggest effect that rising interest rates may have is the fixed income investors. Bond investors, bonds actually have a negative correlation to interest rates. So when interest rates rise, the value of your fixed income portfolios go down. So it may be counterintuitive, but when you're holding a bond and interest rates rise, your bond that's already out there, already paying interest, is now paying a lower interest rate than newly issued bonds. And so you're not going to be able to sell that current bond for as much. So that is something that is at risk, as well as I would say any company that uses a greater amount of leverage. Growth companies are examples of that. They're growing rapidly, they're borrowing money, and when the cost to borrow money goes up, it slows down the growth of those growth companies more than it would a company that doesn't have as much debt on their portfolio or on their balance sheet.
So how best to prepare for these higher interest rates?
Well, to really kind of navigate and strategically align your portfolio, understanding that rates are going up, I would say reduce your dependence on those type of companies that have done really well in this lowering interest rate environment that we've had. So real estate's done very well over the past couple of years. I'm not going to necessarily say drop all the real estate or the REITs within your portfolio, but maybe make sure that the companies you are holding are healthy, higher quality, REITs, or the type of companies that aren't as affected when interest rates are rising. That there are certain sectors, even within the real estate market, that are going to have, that may continue doing well, while other sectors within the real estate market, aren't going to do as well. For the fixed income investors, what a really good strategy would be is to go shorter term into bonds that you're holding. So rather than holding long-term 20-year bonds, reduce it down to maybe 2, 3, 4, 5-year short-term bonds. And within those holdings, you may even consider doing a laddered approach. So what that means is that what you're doing is you may be purchasing some bonds that mature in 6 months, some bonds that mature in 12 months, some that mature in 18 months. And as these bonds are maturing, you're able to then repurchase kind of further down the ladder at higher interest rates as rates are rising. And it's going to give you an average rising interest rate, portion of your investment portfolio. And in general, just all around, any stocks that you hold, make sure that you have higher quality stocks with lower debt on their balance sheet. Right. So we have seen a cycle where growth stocks have done very well. Already we're seeing where growth stocks are kind of the leading, they're the most down this year to date. The NASDAQ has gone down more than the S&P 500, and value stocks have done better than the companies that are considered growth stocks, because they have less debt on their balance sheet, and their valuations are more based around the fundamentals of the company rather than future growth and earnings.
All right. Let me just go back to fixed income for a second. What about floating rate bonds? Are those particularly useful?
Yes, absolutely. Floating rate bonds are a great option for any individual that is kind of looking for a way to navigate the rising interest rates, but they want to stay in fixed income. Floating rate bonds don't have, there are bonds that don't have a fixed interest rate, but they're tied to an index like inflation or like different bond indexes that will go up as rates are rising. Think of it like an adjustable rate mortgage. If rates are rising and you have an adjustable rate mortgage, your rate's going up. The investors in floating rate bonds are getting the benefit of rates that are going up, and they don't necessarily have to have such a laddered approach to it, as they just have the floating rate within their portfolio. Yeah. And you can do that in combination with the laddered approach or short-term bonds as well.
Yeah. I think one takeaway from your article on this topic is, for me anyway, is the notion that having a plan in place to manage times like these is far better than having no plan in place and reacting to a rising interest rate environment.
Absolutely. Just having an understanding of what's happening and going on in the economy allows you to strategically put the pieces in place to be prepared, so that when things are changing, you're not left unprepared and losing sleep at the end of the night. You can confidently continue on with your plan, knowing that you've done the best job to combat what's coming ahead.
Mm. So Matt, we've covered a lot of ground. Anything we missed, or anything that bears reemphasizing?
I think you really said it there with having a plan in place. If you're managing your own portfolio, consider some of the things that we were doing here. And if you're working with a financial advisor, talk to your financial advisor about how interest rates are rising, and make sure that you're best positioned for interest rates and for what's coming ahead.